Welcome to Eliminate. I want to talk to you about you, the banks, and the future you. So I just want to show you guys what we talked about the last time about the cash flow concept. Um, First of all, I just want to reiterate about the credit card payment that we're utilizing to add to the extra payments to the mortgage or the HELOC and the savings part. So let me take you to the calculator. So this is called the eliminate mortgage calculator. This is not the actual calculator that will calculate all your income and your expenses and your loans to pay your mortgage in 8 to 12 years. This is just an Excel worksheet just to just show you the numbers pretty much um, that we're doing, for the whole course. So anyway, so I just want to start with your mortgage. In here, you can see that I put the loan amount of 875,000 with a 5% interest rate with a 30-year length in years. So in here, let's say we started. Let's just do it today. What's today? It's December 9th. Just December 1st. Okay, so we started December 1st. You have you have all these loans, all these numbers, and as you can see, right? We didn't do anything here. We didn't add anything. So as you can see that you will be paying your house in 30 years, and the total payment that you are going to be paying in total will be $1,690,987, right? And the total interest that you paid for the whole mortgage loan is 815,000, which I put in here. So pretty much what you did is bought two houses, right? One for you and one for the banks. Okay. So this $815,000 of interest went to the bank. And whatever your loan amount is your house. So in 30 years, you have bought two houses, one for you and one for the bank. Now, the numbers I was talking to you earlier, right here, if we go to another modified calculator that I did, as you can see, I added your household income of $9,551 and your total expenses, which are the mortgage, the car loans, the credit card, and the living expenses. It will total to $7,897, right? So the difference of the two is the 1,654, which is the savings part right here. And we also said that we are going to pay off your credit card payment, which is $800 right here. So I add it right here. So now, based on this calculation, we know that we were paying $700 towards two car loans. So what I did is I went on to a credit card calculator. I'm sorry, the auto loan calculator. So the monthly payment of 350 is half if one car. So two of this will be two cars, right? So with this amount, let's say you that $700 payment, right? Two of the 350. So $700 payment, we were going to pay that in 60 months. Okay, so there's a total of 5 years of of payments, right? So what I did over here is I went to the, let's say, to the first 5 years, right? You're only paying extra additional payment of $800 a month, which is coming from the credit card because we pay it off. But we're not gonna pay off your car loan. We're just gonna pay it regularly for the first 5 years. right? So on after we paid off your car, right? So that additional payment, the $700 additional payment that you're paying the car can be added to the mortgage. So at this point, from starting on year 6, right? Okay, we'll be using that $700, adding it to the $800, will equal to $1,500, right? And we are going to use that number all the way down till we pay it off at 13 years. Okay, and 1, 2, 3, 4 months. Okay, so I just want to show you the power of the simple calculators. Okay, it's just an Excel, right? Which it can tell you like what are we saving, right? So if we do it this way, you will pay off your house in 13 years and 0.33 years. So 13.33 years, right? And the total interest, now this is the bank's money now, right? So now they're not getting 800,000, right? Now they're only getting 330,000. They still need to make their money because they lend you the money in the first place, but they're not getting a whole house, right? Now they're getting less than half of a house. Okay. So now you're getting 1.5 value of your house now, right? Because now interest savings of 483 plus your 875. So you're looking at, about 1.5 the value of your asset now, right? Okay, so now, so what are you gonna do if you pay off your house in 13.33 years, right? So now, what I want to show you is is let's say you're 46 years old, right? And let's say your retirement age is 67 years old, okay? And those annual payments that you're not gonna be paying anymore, right? Is $56,000 every year, right? So remember, you paid off your house in 13 years. Okay, so you have about 16.67 years left that you're not going to be paying a mortgage of $56,000 a year. Okay, so imagine if you can save that money towards an investment account or a savings account that's just averaging 3%. Okay, I think we can find you a fixed interest of 3% that is safe, right? And also liquid at the same time, right? A place where you can put that money where you don't have to worry about market downturn, right? And or uh, anything can happen in the world, right? Your money is going to be safe. You'll get a fixed 3%. Okay, so in this scenario, okay, you have from a current age of 46 till 67. Okay, so let's say your retirement is not until 21 years. Okay, so in this scenario, because every number from here, okay, everything that we're saving, everything that we're not paying anymore, I put it in here into the savings tab. Okay, this is just to show you an illustration what will be your future value of that money that you are saving now, right? Remember, you paid off your house in 13 years. Now you have 16 years left to save the money, right? Earning 3% of interest. And if you retire age 67, your money will grow to $1.3 million, right? So you have your $1.3 million. Okay, actually, let me open up a new tab. So $1.3 million. Let's choose the number. Okay, plus 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 um, plus your loan amount, right? Because you paid off your house, so you actually paid off at $875,000, right? So let's go ahead and put $875,000, right? Plus whatever we're saving. Okay, this is also part of your money now, right? Because actually let's not add that to the mix, okay? Because this interest, you didn't really receive that money today, right? Because you paid off your house. So and let's just do the math, okay? So now we're gonna have future savings plus whatever your loan amount is, right? So at the end of the day, you have earned $2.2 million, right? In 30 years. So think about it, guys, right? In 30 years, your money will, or at, at when you retire, you'll have about $2.2 million of asset. So this is the power of eliminate, helping you pay off your house in less than half the time, okay? And using the same money that you're supposed to be paying for your mortgage, right? And save that towards your retirement. Because before we talk about eliminate, for most of you, right? Retirement was hard to think about. But now, since we have these tools, right, we can actually use the bank's tools to help us get us to a retirement of $2.2 million. So if you guys have any question, please give us a call, email us, or chat with us and let us know how we can help you. Once again, this is Eliminate Mortgage, and thank you for watching.